Hey everyone, welcome to today's edition of the Final Bar. We're going to wrap this crazy market week, a bear market phase, but with 9 to 10% swings both ways, down one day, up the next. So we're going to try to make sense of today's movement on Friday relative to the rest of the week. We're going to look at some long-term charts, also answer some of your questions from the mailbag related to the markets in the last couple weeks, overbought and oversold conditions, etc., etc. Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller, Chief Market Strategist here at StockCharts.com. Thanks for tuning in with us every day after the close to break down what's happening in the markets from a technical perspective. And I tell you what, in this week, I have seen more often than not the impact of non-technical things on the market, right? All of the macro issues, all of the challenges we're facing as a society. But I will tell you, there is a great benefit to looking at the charts in this sort of environment, because this is how you see visually how the supply-demand picture is changing, when the fear is driving things up or fear is driving things down. And the charts are the best way to understand that. And having been through a number of bear market phases over my career, 20 odd years or so, I've been through a number of these sort of environments. And I will tell you, charts become so much more valuable when things are challenging, especially just with increased volatility. So try to break those things down today. Coming up on StockCharts View, we have some really good content and some wonderful guests for you. On Monday, our next episode of Behind the Charts is going to feature Jeff Hughes. Jeff is a portfolio manager based in Minneapolis, an interview style show, great conversation about his background and his routines, his process. Then on Tuesday, on the Final Bar, my guest is Tim Tashler. On Wednesday, David Auerbach. And on Thursday, Cliff Droke. So we have some really good guests. And again, the guests this week have been fantastic, just giving some different perspectives, helping us make sense of what all is happening. So just on that, let's get right to the market recap. So I remember being downstairs not too long ago, watching the President Trump announcement about the national emergency. And I'm looking at the charts, looking at the clock, and I remember thinking, there was a bit of a delay. It was supposed to originally be at 3 o'clock Eastern. As it got closer and closer to 3:30, I realized he comes out and says something dramatic, the market could just explode from here. And that certainly seems to be what we had after that moment, right? So the S&P finishing up back over 2,700 one day after gapping down and just exploding downwards through it, up over 9% to finish at 2711. Mid caps, small caps up as well, but a little less than the large cap index. We'll come back to the VIX because it's down, but still pretty elevated. What's interesting here is how some of the sectors really rallied on today's movement. So financials up over 13%, technology almost 12%, followed by energy. Down on the bottom, you had some of the defensive stuff, utilities, but also some of the traditional offense like consumer discretionary, right? So both of those still up, but up about 5.5% to 6%. So it was not just a traditional offense up, defense down. So something like energy was up pretty good today. Real estate up pretty decent. And on the downside, you have something like consumer discretionary, even something like healthcare that's been doing better at times. So it was more just I think, a huge rapid fluctuation. I think, this was just one reaction among many. And so I wouldn't draw too many conclusions on specific sector leadership or laggardship today. I think given the move and how severe it was right out of the into the close, I think that's something that'll sort of even out over time. Let's look at a daily chart of the S&P, though, and think about what this actually did. So yesterday, my guest was Julius de Kempener. The day before was Aaron Swenlin. We talked about this downtrend, talked about this breakdown with Aaron. We talked about this key support level broken down. And with Julius, we're looking yesterday and just thinking how low this could go. I was talking to my friend Dan Russo yesterday morning. We were talking about just downside targets. And I said 2350 has been something. And he mentioned a couple of weeks ago, that seemed outrageous. But look at how that's one down day and we could get there. Again, what a difference a day makes, right? So leading into the weekend, we have a huge rally. It sold off during the day, and it felt like we might be on the way to making new lows again. But again, the juice at the end of the day, the last 30 minutes really pushes things higher. So again, overall, let's keep it all in perspective. The market still down over the week in a pretty big way. Today's rally puts us a lot less of a downside than we could have been otherwise. What this also does is it really drives home this bullish divergence, and not to jump too quickly to what we might get in our mailbag, but I know someone had asked about the bullish divergence on the S&P, and I think, I was not thinking that was a valid approach until you get another upswing to sort of validate the fact that a short-term bottom may be in place. It might be what we've seen today, in which case you do have a bullish divergence here coming out of the lows. And in general, I like divergences more from the peaks, but maybe we'll get to that in the mailbag segment, try to break that down a little further. But interesting to note that that pattern. I did want to point out again, energy up pretty significantly, and this has been, a really interesting space where stocks have been beaten down so much on the weakness in oil. But you see how much those stocks have come up. Oil itself, the USO up over 6%, so not as much as stocks, but still pretty meaningful. Gold, on the other hand, was down 3% today, sort of a safe haven coming off. The VIX a lot lower, 24%, 23% lower than yesterday, but let's remember this is still well above 50. So in historical ranges, we are still way higher than we are normally by any measure. So let's not get too excited about the VIX coming down. I think it's still pretty high place. All of this movement certainly had its effect on the bond markets. Bonds had actually been testing yesterday's close a couple times in the morning session, but by the end of the day, had rolled over down over 2%, and that pushes the yield on the 10-year about 95 basis points, and that's where we're at, up 12% from yesterday. In terms of stock movements and group movements, and again, this picture changed so dramatically going into the close. Usually I have some time to review some of these, and I'm sort of looking at them with fresh eyes with you guys. Interesting to note that Brazil, Australia, some of these commodity-oriented indexes up a ton. These are up significantly, followed by India and Russia. So a nice big recovery there. On the downside, and again, everything up, but the things that were up the least, Japan, some of the developed markets here in Europe, things like Germany, also the United Kingdom. In terms of groups, you had some of these beaten down groups. Something like coal comes to mind. Again, it's been so beaten down. I hesitate to draw too much excitement from that being up 35% because you're coming off of a huge depressed level. I am interested in seeing things like banks and asset managers where there's a lot of market cap, big groups driving financials, and this is the reason why the financial sector was number one. You had banks up 15.5%, asset managers up 14%, recreational services, followed by oil equipment and services. So you have a lot of these, groups that if things are going to get better, these are some of the groups where you might expect some resiliency, and you're certainly you've seen that now leading into the close. In terms of groups that were down, the things that had been leading so dramatically, like gold and gold mining stocks, down big today, with everything else rallying, with sort of an alleviation of the negativity, more of excitement, more euphoria almost leading into the close. You have those groups being driven down pretty dramatically. Also interesting to note, home construction. This is a group that actually had been holding up okay on a relative basis and really has sort of dropped down to the downside. So there's just a couple of the industry themes. Again, I'd encourage you to spend some of the time that you have after the show, hopefully maybe over the weekend, to dig into some of those things that have moved a lot. Also want to point out, as always, some of these scooter rankings. We're going to look at them in a minute as part of our weekly update. But I'm interested in noting big, large cap stocks, Dow members, something like Goldman Sachs, being one of the biggest scooter winners. That tells you there's been a big rotation into that name. That's a lot of ideally institutional support that's putting that higher. Sort of a bet on the fact that banks have bottomed out in the short term. So some really interesting charts all around the way. We need to take our next step in the show, though, and go right to our Wrap the Week segment. So at the end of every week, what I like to do, and this is really based off of my weekend routine, I like to look at a series of charts, take a step back. Now that the markets are closed, we've got the weekly close locked in. Let's look at the big picture. Think about how this week fits into the longer term trend. Again, my goal with all of you over time is to always connect what we're seeing right now with the big picture, and no better time than now in this sort of environment to try to orient yourself effectively. So we're going to start with the Mindful Investor Live chart list. Again, if you've not seen this before, if you don't have it, on StockCharts, go to the articles page, go up here to StockCharts blogs, you can go to my blog called The Mindful Investor, and you'll see this link right here that says live chart list. That's going to get you right back to this point where we can look at some of these charts together here. So again, you can say that right to your login, by the way. So looking at the first one, this is a market trend model. I tweeted this out earlier with some comments on what this means, and just to share with you, when you're thinking of the long-term trend, we have a lot of tools in our toolkit to understand the short-term movements, but I like to have something that's more of a long-term trend following mechanism, not triggering too often, just giving me the big picture. Are we in an uptrend or a downtrend? And it's based on long-term moving averages. Mine's based on the 21 and 34 week moving averages. I've also at times used the 13 and 34 week moving averages. They give pretty similar signals. The idea is it's not going to give signals very often. There have been years at a time when it doesn't trigger. It just kind of stays long and strong or in a certain configuration. But what it does do is it's meant to trigger before a climactic loss, a beginning of the move, which is what we saw this week and last couple weeks. It has not triggered yet. It's still long-term in the bullish category because it's not going to trigger until things really start to go lower. So it would be designed to prevent a much deeper loss going down. It's trying to keep you out of a secular bear market too long. So having said that, still positive, and it's really because of the severity of the sell-off that will make a trend-following device. We'll have to wait a little bit to catch up to that. So the weekly PPO here, using it, you can see it's been bullish since the second month of this year, coming off of the lows last December, and has remained positive and remains so. But the shorter term sort of tactical read that I incorporate on this is a weekly PPO, similar to a weekly MACD, using the traditional settings 12, 26, and 9. And as you can see, this turned negative in mid-February, sort of suggesting, it was on that big down week saying short-term trend is down. So even though the longer-term trend is up, you want to sort of take some risk off. And that's where it's at right now. Still negative short-term, but long-term still saying we're in an overall positive trend. We'll have to see how the coming weeks play out. I would point out on the weekly chart, remember, as exciting as Friday's move was, that brought us back up to about the midpoint of this last week. By any definition, looking at the weekly charts, it's been a down week. And again, I would continue to think of it that way. Going into next week, we'll have to see how things play out. Going quickly through some of these other charts, this is the breadth measure we use a lot of times. And again, by any description, the advanced decline lines have been fairly negative. Breaking down through the most recent swing lows has been key, and that's after a bearish divergence with a lot of the advanced decline lines that we saw. This is not updated for today, so I'd expect that to jump up in a pretty big way. It's going to recalibrate these a bit. We'll have to see next week how we fit that into the big picture. But leading up to today, for sure, overall leaning negative. It takes a little while to sort of change that and go more positive. This is another one updated as of yesterday. This is our new highs and new lows. So it's basically when the New York Stock Exchange in the very bottom panel, the S&P 500, new 52-week highs, new 52-week lows. Again, this isn't updated yet for today's close, but you saw yesterday 300 out of the S&P. So 60% of the S&P saw a new 52-week low yesterday. That is really extreme, and you'll notice what I point out when I talk about these this sort of environment and why it seems so unusual. When you look left on the chart and you find absolutely zero historical reference because we've never been this low over that period, that's when you have to really look at the longer term stretch and try to make sense of it. So let's do that together really quickly. We're going to bump this out, go into the time frame. Let's go back about 15 years or so. That'll take us back into sort of the aught fives or so. That'll give us the 2007 sell-off. So what happens here is you can see with yesterday, with that big sell-off, that puts us in a different territory than what we've seen in these most recent pullbacks, these bottoms within the secular bull trend, and it puts us more within that 2008, 2009 sort of range. That's the last time we really got anywhere near this sort of level, where over half of the S&P was making a new 52-week low. And really, the last time we were over 50% was back here, that leg just before the final leg down, that capitulation low. This was in 2008. So, again, it's hard to draw too many comparisons just based on that. But I'm just pointing out the fact when the breadth has become this negative, it's putting us back in the breadth characteristics of previous major bear market phases, not just short-term pullback. So I would certainly want to remind everyone of that. Again, yesterday's sell-off also pushed the percent of stocks above their 200-day down almost to 5%. We're going to come back up. I think a lot of stocks have reclaimed that, or at least begun to, in some of the higher beta names for sure. But again, it's the lowest reading that we've had in the last 5 years. Again, going back into 2008 is where you'd see previous time. And we only had 1% of the S&P above their 50-day, which is incredibly rare. But again, back to some of those cyclical bottoms. So, in this sort of environment, again, thinking of the charts and just looking at how negative the breadth is, one of two things happens. Either this in some way starts to rhyme with historical cyclical bottoms. And again, we want to look at a lot of reference points to try and see how close we are to that. But the other thing it starts to look like is earlier on in deeper bear market phases. And that's really the concern. So this is a really good time to be thinking about positioning over the weekend, think about stops and all of that. We talked about this one yesterday. I just wanted to bring it up to point out that the AAII, the American Association of Individual Investors, this is their weekly survey, came out yesterday. So it's not going to reflect anything today, but over 50% bears, which again is super unusual, lines up with some of the cyclical bottoms that we saw previously, but much more lines up with the range that we tend to see in deeper bear market phases as well. Now, this ratio is actually one of the interesting ones, and we're going to rotate and look at some of the scooter reports very, very briefly. Looking at the ratio of consumer discretionary versus consumer staples as the market spikes up, this is reflected through today's close. You would expect people to be pushing into offense, pushing into consumer discretionary, taking the high road and expecting the juice if there's further upside. I think it's really worth noting that people are actually sticking with staples. And by people, I mean big institutions, right? The institutions are rotating more and more to staples. That's been a trend that's been going on for a while. Today did not change that. So consumer discretionary is actually one of the weaker sectors today. It was not one of the gainers. So I would hesitate to think too much about that as potential upside here. Finally, I just want to very briefly remind everyone about the scooter reports. We don't have enough time to really dig into these too deeply, but I did want to point out again, today really changed the characteristics of this. If you look at the scooter report, switch it to US industries and go here to the left, say 1 week, you can see the strongest rated groups, and you can also look at change and see which groups were up and down the most. What's interesting here is you see some healthcare, you see some telecom, you see some transportation, some really interesting groups that have gone on the most improved list based on what's been happening through the week today. Again, as we update this through today's close, we'll probably see some new information on there. But overall, very much worth following. We need to take a quick commercial break, everyone. We're going to be back answering your questions from the Final Bar mailbag. So we'll see you in a minute. Hey everyone, welcome back to today's show, The Final Bar. Thanks for joining us every weekday after the close. Please keep your questions, your feedback coming to us. The Final Bar at StockCharts.com via email. That's the best way to get a hold of us. Or during the show, just put a comment in the Q&A. We'd love to answer it in a future broadcast. We're going to go right to answering your questions now from the Final Bar mailbag. So as you can imagine, with the volatility that we've seen with all the surprise moves this week, we've had plenty of questions, so I'm going to pick some of them to get to. I apologize, we can't get to all of them, but we really appreciate your questions, your feedback. We'll get to as many as we can. So the first one dealt with that bullish divergence. I totally hear you. Can we read anything into the positive divergence in the RSI and lower low on the S&P 500? And this question that we actually got yesterday, and I would point out this. So yesterday, I was not a big fan of this divergence as calling it a divergence, because remember, this in falling knife mode, the market can keep going down and down. So even the day before on Wednesday, we're going to new lows. We're almost at 2,700. It also looked like a bullish divergence here at the time, but the downtrend was still in place. So you have to remember, in the process of a downtrend, the process of a steep sell-off, you can't read too much into the divergences yet because it's still kind of active. It's sort of like looking at a weekly bar when it's Tuesday, right? The week isn't done, so that bar is still going to update. Your signal could totally change. Now that we've had Friday and we've had this reaction move, this move higher, this feels like a short-term low of some substance, right? This feels like a springboard we've come off of. The question we're gonna have to answer next week and beyond is this the V bottom beginning? Do we put in a higher low and we start building, upside from here as things start to improve? Or is this more of the dead cat bounce, something like we saw back here at the beginning of March, the first week, where we had that nice, 50% retracement before plunging to new lower lows? And I don't know which one's gonna happen. No one knows. But I do know the fact that we've now established a lower low now, that I think you now can buy into the fact that this is more of a bullish divergence. I think it suggests next week, from a technical perspective, there's a bit of support there, and I think that is your new support level, 2470, so 2480. As long as we stay above 2470 or so, that would keep that in place, suggesting some potential upside. So again, I would be cautious about a divergence until we're sort of done there. Next question was on bonds. How do we think of those right now coming off of them? And it's a really decent question. Let me get to the TLT chart here. How do you think of the TLT in terms of potential downside? It's a very valid question. And again, this is a V top, which is so unusual. It's almost not a thing you ever describe because it never really happens. But I think we're in the environment where things that never really happen are seeming to happen. So let's get comfortable with it. So for me, what I like to do is look at a Fibonacci retracement in this sort of environment, right? So now I'm taking the low of that most recent pattern. This is from last November. We had the breakout there, and then we accelerated. And again, the euphoria here was pretty extreme overbought with an RSI above 80. Now we've pulled back, and we've retraced a good amount of this. We're almost 61.8% of the way. What I would see is this. Number one, when we have an extreme overbought condition, more often than not, that tells you you'll have a pullback, that tells you you'll have at least one more push higher. And I think that's what we're going to see with the TLT. And that might be next week that we see that. From a technical perspective, we're right at a pretty decent support level, sort of in this 150, 152 range. That would line up with, sort of this gap up that we saw coming out of that congestion period, sort of that bullish pennant that we saw back here in February. Would line up with those lows pretty well. And also I have to see with the RSI, does it remain above 40? That tends to be our bottom in a pullback situation. But the fact that we were extremely overbought, for me, tells you, I think if you're not, short, if you haven't played this downside, I would be waiting to see if there's a bit of a bounce to the upside, at the very least one more leg higher. And again, how that relates to stocks, we're going to have to see, but I think that's an important one to look at. So, and again, remember the volatility, the swings that we're seeing are unprecedented in recent history. And again, many of you have been doing this even longer than I have. And these are rare moments that we're seeing here. So the best we could do is to try to apply the toolkit as much as we can. Next question related to the PPO. So let me just read this one really quickly. Trying to understand the situation where PPO has crossed up from below zero and is rising, yet price is falling. Oh, that's a really interesting question. I don't know if I can score one of those types of patterns very quickly, but let me try to let me see the chart of the S&P and see if I can get a good example. And if not, I apologize. So what you were saying is basically price is going higher, but the PPO is sloping downward. Sort of a bearish divergence in the PPO. This might not be the perfect example, but it's readily available. So we'll go with it. So yeah, I have seen people apply the logic of divergences to everything, and I get the validity of it. I get the idea of it. For me, though, the MACD, the PPO is not the place I tend to do it. If I remember, I don't want to say like Carl and Aaron doing Decision Point. I want to say that they do divergences with the PPO, but I might be making that up. And sorry to those guys if I am. But for me, that's less of a story than more the trend following. When I'm looking at the PPO, I'm looking at the trends, and I'm looking when they cross up and down. So that's the bearish signal there. That's the bullish signal here. I'm looking less at the divergence and more about the trend following. I use things like RSI for the divergence because it's a pure read on momentum. So again, higher highs, higher lows on the PPO and the price. Less meaningful for me, but I get the logic of it. I have seen people do that with some success. So certainly worth a shot. But again, for me, the RSI is the main way that I tend to measure divergences. Next question. I'm sorry, I'm kind of rapidly going quickly through here. Gold, right? The oversold level. And boy, those levels are updating very quickly here, folks. So let's look at a chart of the GLD. We've talked about this for sure. Have not talked about it yet in today's show. So sure. So gold, we've followed this playbook on gold for a while now, right? Where you've had this, big move, the retracement, the breakout, the big move, the retracement, the breakout happened twice in the last 18 months or so. And then we sort of accelerated to new highs. This is during the sell-off in stocks here in February going into March. But then in the last couple days, and it's not just been the last 2 days, look at the 3 days before that, all week actually, we've been closing down more toward the lows than the highs. And these couple days back here, I remember seeing these when it's around 155, and I'm thinking, boy, that's good. It feels like a pullback here, but I don't like the fact that we keep closing near the lows. That's not feeling like there's a lot of support there. And so this breakdown, I think, is meaningful. So overall, I think here are the things to think about. Number one, the RSI now below 40. And in general, you'd want to see the RSI hold around 40 because that tends to be support in a bullish phase. That hadn't happened, though, a number of times in the most recent couple of years. And so I'm hesitant to put too much into that we didn't quite hold that level enough. But it's worth paying attention to for sure. We've broken below 40. For me, the 200-day around 140, and I think a break below 140 on the GLD would be key. Below that, this low right here, which is around 137, that was the low from last November, December. I think that's the real line in the sand. So I think we're entering that demand area, entering that level where traditionally you'd expect some buyers to buy in right around the 200-day, or if we get down to that 137 level. If we get below like 136, I think you have to bail on the bullish gold thesis and revisit sort of a backing and filling more of a down move. But again, a lot of this came in the last last part of the trading day today on Friday. I think next week is going to hopefully illuminate some of those questions going forward. That was our digging through the final bar mailbag. Thank you guys so much for all of those questions. We need to wrap the show though. Go to the 3 and 3. So 3 charts in 3 minutes. If these are not on your radar now, they should be from here on out. Our first chart is looking at the S&P market trend. We talked about this in a lot of detail earlier in the show during the weekly, the wrap the week segment. So go back if you missed it earlier. But overall, it's just as a reminder, by my long-term trend following read, this is still saying it's okay. The long-term trend is still okay. I know that feels crazy when the spiders go from 340 down to 250 to settle back at 270. I totally get that. This is not designed to capture that sort of move. What is designed to capture that sort of move is here at the bottom, the weekly PPO. That did turn negative 3 weeks ago, suggested to be more risk off. And I think that's what hopefully prepared everyone for that potential downside. This is a chart I am watching because if and when we would trigger a sell signal from those long-term moving averages, that tells you we are really at historic trend turning sort of points if we haven't gotten there already. Chart number 2 is the banking index, the Philly banking index, $BKX. A lot of people look at the XLF, and that's totally fine. It's just another way to sort of look at the banking group. Such a huge reversal. This is, hit 65 yesterday, almost to 75 today, closing just below there. This had been oversold consistently for the last month. In the last 3 to 4 weeks, pretty much had been in the oversold region. And look at how the relative strength had exploded downwards. I think it's a little too early to consider this to be a raging buy signal. If you're more of a bottom fisher, if you're looking more for deeply oversold opportunities, I get the idea of trying to, take a shot on something like this or something like energy coming out of those extreme lows. For me, I am a little more conservative, and I'd love to see a higher low of some sort. This is not the end. I mean, I highly improbable it would just go vertical from here. You probably have a pullback, and I'd want to know, do we finish higher or finish lower? That would tell me whether I'd feel comfortable taking a shot at something like banks. Our third chart is technology. So as the market recovered today, you can see tech up in a big way, almost back to the 200-day moving average, the relative strength spiking, continuing to be positive. And what's amazing about tech, I love groups and stocks and sectors that are outperforming in bull phases and outperforming in bear phases. Technology is that. So it's done well pretty much in any environment. So in terms of thinking of core positioning, thinking of a core spot that it would be safe to park in, something like tech certainly feels like the type of place I would probably want to be considering on the long side. Ladies and gentlemen, that's our show for today. That's a week for the final bar. Thanks for joining us today and every day after the close. Thanks for sending your feedback to us, the final bar at StockCharts.com, or hit us up on Twitter at FinalBarSCTV. Really appreciate you tuning into StockCharts. We have a lot of really good content. All of my fellow hosts sharing their wisdom, sharing their expertise, sharing their ideas. So check out our YouTube channel for the other shows, for all the old videos and all of their previous thoughts. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend. Bye-bye.